need to look at what central banks are and how they operate. And that allows us to explain how banking works and why we have the recurring banking crisis. Let me do that. In fact, it goes back to a fundamental question. How do banks operate? And actually there have been 3 theories on banking for over a century, 3 different explanations, and I'm sure you will have encountered all 3 at one stage or another. The currently dominant theory is that, banks are just financial intermediaries. And this one is being reinforced a lot by the financial news reporting, by statements from central banks, and also if you look into academic and research literature, the leading journals, say the Journal of Finance, American journal, considered number 1 in the area, it considers banks nowadays as financial intermediaries. What does this mean? It means the banks gather deposits on the one hand, then they do their thing, their analysis and their credit risk assessment, all these things, whatever it is, good or bad, and then they lend those deposits. So they're just in the middle, a middleman. There's the middleman theory of banking. That one is currently dominant. And also bank regulation, how actually regulators look at banks and how they regulate them. The entire approach to regulation, which you know is this Basel approach. We can come back to the specifics, but this Basel approach is also based on the assumption, the belief, that banks are just the middlemen. They gather deposits and they lend them out. Now, if you go back in this Journal of Finance to the 1960s, you might get confused because it's the same journal, but in the 60s they were talking very differently in this journal. Because then, still, just about, the previous theory of banking was dominant, which was dominant from the 1920s to the 1960s. And that one, you will also have heard, maybe once or twice before, the fractional reserve theory of banking. This one is connected to another concept known as the money multiplier. I think a lot of ears of those who haven't looked into economics and finance should prick up now. When I was a student and I heard this money multiplier, oh, that sounds interesting, I thought. What is that? The money multiplier, the magic money tree. So, well, just very briefly, in fact, there's a similarity of the fractional reserve money multiplier theory of banking to the middleman, intermediary theory of banking. Namely, it says, yes, each individual bank is an intermediary. So also this fractional reserve theory also says that. But they say, as you put many banks together, so you've got many banks now, they interact and they do their things, overlapping, interacting, then something happens. Somehow in this system, as the banks interact and operate together, money is being created. There is money creation going on. It's not the central bank. We're not talking about central bank money creation, okay? Now, the actual technical details are a little bit complex. Students are always confused, and there's actually a reason it's meant to be confusing. So don't worry if you think this sounds a bit confusing. You can look it up later. Fractional reserve theory of banking, money multiplier. The main point is, it says each bank is a middleman, an intermediary, but in aggregate, collectively, and it's interesting that there's a recognition, we have to look at something systemic, which is different from each individual bank. Something happens and money is being created. And of course, you can imagine if that's true, and if money is being created, this will have an impact. There will be some consequence. This, therefore, means there should be a different approach to bank regulation. And the approach to bank regulation, going hand in hand with this fractional reserve money multiplier theory of banking, is the old reserve requirement approach to bank regulation, which was dominant, in fact, during that era when fractional reserve theory itself was dominant, which was until the early 80s, 1980s. Even the Federal Reserve and the Bank of England were looking at reserve requirements. It's a bit monetarist, looking at money aggregates. But then that was scrapped as from the 60s, 70s onwards, this financial intermediation theory of banking became dominant. And then we have the Basel approach, which is all about capital adequacy. It's all about capital, not reserves. We'll come back to this regulation, but okay, now there's one more theory of banking. You need to hear the third one now that we've come this far. Namely, until roughly the 1920s, this theory was dominant. And this theory says that no, banks are not financial intermediaries, neither individually nor collectively. So this is a different theory. This theory says when a bank gives out a loan, a bank loan, we're just talking about ordinary banks, commercial banks. When they give out a bank loan, then money is being created. Money is being created essentially out of nothing. Economists tend to write ex nihilo because it's a bit embarrassing, out of nothing, and it's too obvious. It sounds too shocking. So put it in Latin, sounds more technical. This theory was dominant until the 1920s. Now, we've got these three theories. If the oldest theory, that banks create money, is known as the credit creation theory of banking, is correct, then you need also bank regulation consistent with that theory. And it's not the fractional reserve approach and the reserve requirement approach, and it's not the Basel approach. Notice the Basel approach has not been very successful. We've had so many banking crises since the Basel approach was introduced in the 1980s. Basel I, Basel II, Basel III. It's like these, movie installments.
Yeah, could you just briefly explain what that is? I'm not sure everybody knows what Basel I, II, III is.
Yes, this is the currently dominant approach to bank regulation. And the fundamental idea is that, well, we can somehow contain and control and regulate banks if we give them a requirement to hold capital, what's called as capital. Now, what's this capital? It's just, when you look at a balance sheet of any company or also a bank, you've got equity from shareholders, that's the capital. There's some slightly different types that can exist, but we don't need to go into this. So that's the capital. And banks, so before the 2008 crisis, had not much capital. The large internationally operating banks had capital around 2 or 3% of their balance sheet. That, by the way, is already a quick explanation why we've had all these banking crises, because you can have them very quickly. Particularly if the oldest theory of bank behavior, the credit creation theory, is correct, that banks create money. This will have consequences. And then the Basel approach imposes capital requirements. You must hold 8%, simplified, and it's not quite true for the big banks. It's actually much less than 8% of your balance sheet in capital. Then this is some kind of security to ensure stability, was the thinking. But it's not true, because, and to answer this, we must now ask this fundamental question. I'm sure you want to finally hear this. So which of these three theories is true? And then I can answer your question properly about Basel. Which of the three theories is true? Because Basel is linked to the currently dominant theory that banks are just intermediaries. And if that was true, then Basel has a chance to work. We have famous economists supporting all of these theories. The credit creation theory is supported by Schumpeter, for instance, Austrian economist, and also the young Keynes supported that one. Then the fractional reserve theory is supported by Alfred Marshall, famous neoclassical economist, and also by the slightly older Keynes, and by many other economists. And then we've had the financial intermediation theory, which is supported by essentially all economists nowadays. But which one is true? Well, we need to test this empirically, is what I thought. Over a century of debates, but no empirical test. What is the scientific way of doing this? You empirically test this. Well, all the three theories differ when it comes to the question of where does money come from? I've actually written a book with that title, Where Does Money Come From? Because when you take out a loan from a bank, the question is, where does the money for the loan come from? That's where the three theories differ. The financial intermediation theory says, oh, the banks take deposits and then these deposits are lent out. So in a loan, the money comes from deposits. The fractional reserve theory says that the banks need to hold excess reserves in order to lend. And so the money for the loan comes from excess reserves. And the credit creation theory, you may guess this one, says the money comes from nowhere. The banks create the money out of nothing, because that's the most shocking theory. So I ran this experiment a few years ago. I actually took out a loan from a bank, and the bank was collaborating with me in this experiment, this empirical test, because I told them, look, I will take out the loan, I will transfer the money away from you to my own old bank, and I want you to show me exactly what you're doing, what transactions, what bookings you're doing internally in your system. I want to see where the money comes from that is booked into my account. It's a reasonable approach. It took a long while to get a bank to cooperate. Initially, they all said, yes, sure, we'll do that, the big banks. And then when it comes to actually wanting to see their systems, oh, no, this is far too sensitive. And all sorts of reasons you cannot see this. But I managed to find a bank in Germany that collaborated. We actually had the BBC there filming this empirical test. I took out a live loan, 200,000 euros, and I was going to transfer it away from the bank. And we looked at the bookings and what they did, and it turned out, where did the money come from? It was not transferred away from any other account inside the bank or outside the bank. It did not come from deposits. It did not come from reserves at the central bank. In fact, they didn't care about their reserves. They didn't even look how much they had. Reserves were not affected. It was newly created. How does that work? Well, the best way to understand this, if you look at the law, this is of course one of the reasons why economists don't understand banking, and they leave out banks in all their economic models, because they never look at the law. Law is reality. If you've got an issue, well, you can use the law to claim your rights, and the court will decide, and that is the result. And you can challenge it to higher court, but ultimately, the highest court will make a decision, and that is it. That's reality.